Chapter 6. What life insurance involves. This chapter tells us about an asset in terms of life insurance, types of risks involved, the principle of pooling, and the term contract. Let's understand the term asset. In layman language, an asset is a kind of property that yields value or a return. Value of an asset is measured in monetary terms. Similarly, the amount of loss of value can also be measured. Let's take an example. When a car meets with an accident, the amount of damage can be estimated to be somewhere around 50,000. The insurer or the insurance company will compensate the owner for this loss. How do we estimate the amount of loss when a person dies? Is he worth 50,000 or 5 lakhs? We don't know. That's where human life value calculation comes. A measure developed almost 70 years ago by Professor Jubener, known as human life value. The human life value concept considers human life as a kind of property or asset that earns an income. It thus indicates the economic loss a family would suffer if the wage earner were to die prematurely. Let's take an illustration. Mr. Raj earns rupees 1,20,000 per annum and he spends 24,000 on himself. If he is no more, the net earnings his family would lose would be 96,000 per annum. Suppose the rate of interest is 8%, then human life value will be calculated as 96,000 divided by 8%, which is 12 lakhs. So human life value of Mr. Raj is 12 lakhs. Now let's move ahead and try to understand the term risk. Typical concerns faced by ordinary people are dying too early, living too long, living with disability. So in order to overcome the risk of dying too early, a term insurance can be used as a tool. Similarly, for risk of living too long, an instrument such as savings plan or pension plan can be used. And for the risk of living with disability, an insurance plus a rider such as accidental or disability riders can be used. Moving ahead, let's understand what do we mean by level premium. It is fixed such that it does not increase with age but remains constant throughout the contract period. Premiums collected in early years of the contract are known as reserves. An insurance company keeps this reserve to meet the future obligations of the insurer. The excess amount also creates a fund known as life fund. Life fund invests these funds and earns an interest. The principle of risk pooling. The insurance industry basically runs on the concept of risk pooling. In insurance terms, risk pooling is the sharing of common financial risk evenly among large number of people. The structure arises from the application of mutuality or pooling principle. Let's understand the difference between diversification and mutuality. Diversification is a process where funds are spread out over various assets. It's as simple as placing the eggs in different buckets. But in mutuality, funds of various individuals are combined. It is as simple as placing all the eggs in one bucket. Coming towards diversification. Funds flow from one source to many different sources, nothing but many destinations. Whereas in mutuality, funds flow from many sources to one. Now let's understand the advantages of life insurance contract. First and foremost, it's safe and secure investment. It provides the discipline towards savings. It provides liquidity in terms of loan or while surrendering the policy. The next advantage is income tax benefit. Tax deduction under section 80C or exemption under section 1010D. It also helps in maintaining the standard of living. So these were the few advantages of life insurance contract. The next few disadvantages of life insurance contract are the high marketing and other initial cost of life insurance policies reduce the amount of money accumulated in earlier years. The returns may be less than that of other financial market instruments. Thank you and wish you all the best.